Silver just hit a wall. Prices have been hammered lower for months while gold sits near all-time highs. And if you're holding silver or thinking about it, you're probably asking yourself a painful question right now. Why is gold racing ahead while silver gets left behind? The answer most people give you is simple. They'll say silver is too industrial. They'll say manufacturing demand is weak. They'll point at the Fed's rate hikes and say higher rates kill metals. And on the surface, that explanation feels right. But that's only the surface explanation. Here's what most people miss. The crushing of silver right now isn't a sign of weakness. It's actually setting up one of the most explosive asymmetric opportunities in commodities. And the mechanism behind it tells us something profound about what's coming next for the dollar, inflation, and your wealth. By the end of this video, you'll understand why institutional investors are quietly accumulating physical silver while retail panics, and why the next 12 to 24 months could look radically different from what you'd expect. Let's start with what you're actually seeing. Silver has been under pressure. It's true. Prices peaked around $32 an ounce in March of this year and have since retreated. Meanwhile, gold hasn't just held ground, it's climbed steadily toward record territory. And this divergence has created something that feels counterintuitive. If inflation is still a risk, if central banks are still destabilized, if geopolitical tension is rising, why would silver, the monetary metal, the inflation hedge that's supposed to move with gold, why would it disconnect so violently? The confusion runs deeper than that. Silver has real, genuine supply and demand fundamentals. It's not just a macro bet like gold. Industrial demand, photography, solar panels, electronics. Silver has actual use cases. And those use cases should, in theory, create a floor under price. But that floor hasn't held. Many investors have been punished. They loaded up on silver thinking it was the smarter leverage play to gold. They believed the gold to silver ratio would eventually normalize and deliver outsized gains. Instead, they've watched their positions move sideways while gold races ahead. And here's where the pain deepens. The mainstream financial media hasn't helped. They've been relentlessly dismissive. Silver has no real story, they say. It's just a leveraged play on gold that's failing. Some analysts have even declared silver dead as a macro hedge. For someone holding silver or trying to build conviction, this is psychologically brutal. But that's only the surface emotion. The real mechanism is far more interesting. Step 1. Understand what's happening in the dollar right now. The US dollar index has been volatile but fundamentally strong compared to other fiat currencies. The Fed kept rates elevated longer than most expected, and despite all the talk of a everything bubble and reckless spending, the dollar has actually been a relative safe haven. When people get scared globally, they still buy dollars. That matters because precious metals are priced in dollars. When the dollar is strong, it makes gold and silver more expensive for foreign buyers. It creates headwinds. That's part of the story. Step 2. The gold-silver disconnect has a specific mechanism. Central banks have been the dominant force in gold markets over the past 3 years. The ECB, the Bank of England, major Asian central banks, they've been accumulating gold at rates not seen in decades. In 2022 and 2023, central bank gold purchases hit 50-year highs. This demand is structural. It's not cyclical. It's not based on technical charts or Fed expectations. It's geopolitical. Central banks are de-dollarizing. They're reducing exposure to U.S. treasuries and building physical gold reserves. This is a slow motion but very real rejection of dollar hegemony. Silver doesn't fit into that narrative the same way. Central banks don't accumulate silver for monetary reserve purposes. They accumulate gold. So while gold benefits from this structural central bank bid, silver doesn't. Not directly anyway. Step 3. The real mechanism behind silver's weakness. Here's what most people miss. The silver price right now is being suppressed by something much more specific. It's being crushed under the weight of a technical factor, the gold to silver ratio. When gold is exceptionally strong relative to history, when that ratio reaches extremes, it creates an opportunity that smart money has learned to exploit. And right now, the ratio is at 45-1. That means it takes 45 ounces of silver to equal 1 ounce of gold. Historically, that ratio has ranged between 40 and 80. But there are critical moments when that ratio becomes so extreme, so divorced from historical norms, that it snaps back violently. And this is where everything changes. History shows this pattern again and again. Look at 1980. Silver and gold exploded in tandem, but silver's move was far more violent. The silver market, being smaller and thinner, experienced a squeeze that was devastating to short sellers and extraordinary for longs. That wasn't random. That was ratio compression driven by physical scarcity and leverage. Look at 2008. As the financial system nearly collapsed, as credit froze, investors fled into gold. But as confidence eventually returned, as some risk appetite came back, silver rebounded with intensity that made gold's move look modest by comparison. Ratio compression again. Even more recently, look at 2020 and 2021. After the pandemic crash and the initial Fed response, silver went from $12 to $28, while gold went from $1,500 to $2,000. Silver outperformed significantly. Why? Because the ratio was being repriced. Investors were paying more for silver's dual nature, monetary value and industrial utility. Now, fast forward to today. We're in a different setup, but the pattern is similar. The ratio is at historical extremes, and extremes by definition don't last forever. Why does this time feel different? The structural backdrop is unlike anything we've seen since the 1970s, and here's the critical part. It's worse. Back then, we had runaway inflation caused by wage price spirals and oil shocks. The Fed eventually raised rates above inflation and killed both. That hurt financially repressed savers, but the system functioned. Today, we have something far more fragile. U.S. government debt is at $34 trillion. The federal deficit is 3% of GDP in what's supposed to be a healthy economy. The Fed's balance sheet is still grotesquely bloated compared to history, and the real, inflation-adjusted interest rates are still negative when you account for true price pressures, especially in energy, shelter, and services. What does this mean? It means the Fed cannot raise rates much further. If they push too hard, the government's interest expenses become unsustainable. The currency becomes vulnerable. The banking system gets stressed. They're trapped. And here's the geopolitical layer. China is de-dollarizing aggressively. Russia has been cut off from dollar markets. The BRICS nations are coordinating around alternatives to dollar settlement. This isn't a hypothetical threat to dollar dominance. It's an active process happening right now. Add to that supply dynamics in silver. Silver has a deficit. Annual mine production cannot meet industrial demand plus investment demand. That deficit is being covered by drawing down inventories and scrap recycling, but those sources aren't infinite. At some point, if silver prices don't rise significantly, we'll see physical shortages in industrial applications. So what you have is a setup where the dollar faces structural long-term pressure. Precious metals are the asymmetric bet against that pressure. Gold is getting central bank tailwinds. Silver is historically cheap relative to gold, and physical scarcity in silver is becoming a real constraint. The crushing of silver prices right now is creating a coiled spring, and springs eventually release. What happens next? Walk through the likely sequence. Phase 1. Continued range-bound weakness or consolidation. The dollar stays relatively sticky as long as the Fed is perceived as higher for longer than other central banks. Bonds offer a yield, and momentum traders have been net short silver. This phase probably lasts through the next few months. Phase 2, the breakdown. This happens when one of three catalysts hits. Either the Fed blinks and signals rate cuts before the market expects it, or inflation reaccelerates because of a supply shock, oil, geopolitics, weather, or a crisis moment hits in credit markets. Any of these causes the dollar to weaken and real rates to become even more negative. Phase 3. Repricing. Once the dollar begins a genuine multi-month decline, once investors realize that rate hikes can't be sustained, once the reality of structural debt hits harder, precious metals move. Gold moves first, as it has. But then silver moves with intensity. The ratio compresses, and speculators, hedge funds, and retail investors who loaded up on the weakness start covering shorts and going long. This phase is where silver outperforms. Not because fundamentals suddenly changed, but because ratio compression is a mechanical force in a thin market. Silver is also more sensitive to real rates and inflation fears, both of which accelerate during this phase. Phase 4. Stabilization at a new level. Silver reaches a new equilibrium that reflects both its monetary value and its industrial scarcity. That's a level that's materially higher than where it is today. This entire sequence could play out over 12 to 24 months. Here's what you should actually watch for. These are the early warnings that Phase 2 is beginning. First, the yield curve. Watch the 2-year to 10-year spread. When that begins to normalize and steepen consistently, when the inversion that punished the system finally gives way, That's a signal that real rate expectations are changing. That's when precious metals start to feel more attractive relative to bonds. Second, the Fed's rhetoric shift. Pay attention to how Fed officials talk about data dependence. When the language starts admitting that cutting might be necessary despite inflation, when you hear language like restrictive enough, that's the turning point. It doesn't happen overnight, but the shift in tone precedes the shift in rates. Third, central bank activity in silver specifically. The World Gold Council tracks central bank purchases of gold meticulously, but watch for any hint that central banks or major sovereigns are diversifying into silver or accumulating it strategically. If China or Russia starts accumulating silver as part of de-dollarization efforts, that's a structural shift that changes the entire game, and it's absolutely possible. Fourth, industrial demand signals from electronics and solar manufacturers. If you start seeing reports of supply tightness, of manufacturers having to adjust production or pay premiums for silver, that's physical scarcity becoming real. That's usually a few months before prices spike. So here's what this means for you, right now. You're living through a setup where the most hated, most frustrated precious metal is actually loaded with asymmetric potential. The crushing of silver isn't a sign you were wrong to consider it. It's a sign that the market is mispricing something important. Central banks are positioning for a world where the dollar matters less. Debt is unsustainable without serious inflation or serious austerity. Neither is politically feasible. Real rates are still negative, and silver, being both a monetary asset and a physical commodity with genuine scarcity, is the leveraged play on that entire picture. The divergence between gold and silver won't last forever. Ratio compression is not a hope or a belief. It's a mechanical reality in markets where extremes never hold. This doesn't mean silver goes straight up tomorrow. It means the setup for the next major move is being built right now, in the pain, in the frustration, in the dismissal by mainstream finance. History shows this pattern. When institutional money repositions, when structural forces align, when physical scarcity meets monetary demand, the move is sudden and violent. You're either preparing for that moment or you're not. The crushing of silver is bullish, not because sentiment has turned or because technicals have changed, but because the foundation is being laid for a revaluation that's probably 12 to 36 months away. The dollar's structural decline is real. Debt is unsustainable. Central banks are de-dollarizing. And silver, at these prices, offers the asymmetric opportunity for investors who are willing to think in terms of years instead of weeks. If you want more deep macro analysis like this, where we walk through the hidden mechanisms driving your wealth, subscribe and stay close to the channel. We publish research and analysis every single week that most retail investors never see. The window for these kinds of mispriced opportunities doesn't stay open forever.